Nuveen Chief Investment Officer Saira Malik says that while analysts haven't significantly lowered estimates, companies are likely to beat earnings per share in aggregate driven by tech. And I think we're looking for, Saira, about 7-8% in the third quarter. We've had double-digit earnings growth in the previous couple of quarters. Do you think we're going to get that high?
I think that we likely will end this quarter with beating earnings seasons again. What is interesting is normally when you go into an earnings season, analysts lower estimates going in, they lower the bar, and then companies beat earnings. We're not seeing that. Actually, analysts have been raising estimates coming into third quarter earnings season. But with expectations at about 8% for year-over-year growth, I think that companies can beat earnings again and probably print in the low double digits. The leader is going to be tech stocks.
Can we just sit on the consumer for a moment, Saira, because there is this confusion, and hey, Matt, how's it going? There you go. Hey, Saira. There is this confusion at the moment of, okay, Pepsi comes out with pretty good earnings. And again, this was supposed to be a company that maybe was affected by a mass market consumer who didn't want to trade well. Maybe what makes more sense is a delta with the premium consumer doing well. But then you get Ferrari coming out with an outlook that's disappointing. And again, that should be a segment of the population that's doing really well. Do we have any handle on the consumer and consumer-related equities right now?
Well, the consumer their strength has been a surprise this year. What markets expected was that tariffs would come into place and the consumer would weaken. What we have seen, notwithstanding Ferrari, is that the high-end consumer has stayed strong while the lower-end consumer has struggled. So that's the issue there. And what happens from here, we're still not seeing an impact from tariffs in terms of spending and consumer sentiment, but holiday season is still to come there. Our theory is that a lot of companies pre-bought inventory because they knew tariffs were coming. So that inventory is just beginning to be at the tail end of running through it. So there could still be some impact on goods and tariffs in terms of the consumer's pocketbook, but it might not happen until holiday season or early 2026.
I think, and we're going to talk to Craig Trudell, our global auto czar, about this in a second, that Ferrari's problem may be of its own making because their hypercar only has a V6 and their new 12-cylinder looks like, I don't know, a futuristic nightmare of a Daytona. We'll get to that, Saira. I want to talk to you about Google because you're bullish on the stock. It's not underperformed the other Mag 7 stocks other than NVIDIA. It's up 226% in total return over the last 5 years. How much further do you think it could go?
Well, three factors that are driving the markets: government shutdown, AI and deals there, and also third quarter earnings season. So let's go to tech. Tech has been the driver of U.S. equities for many years now. That's no different this year. So what we need to think about is, can AI and Mag 7 stocks continue to drive this markets higher? And if so, where should we be putting our money? We like Alphabet here. And first of all, there's a free option on Waymo and YouTube, upside there. I think the view that Google's advertising business is going to be at risk because of OpenAI is overdone. Google Gemini has a lot of upside to it. All of that, I think, is a reason why Google continues to outperform. Now, the other side, of course, for tech stocks is people will look and say, well, they're just too expensive. But if you look at what's been driving tech stocks higher, it's not so much been valuations, it's been earnings driven. Also, in the AI trade versus the late 90s when there was so much supply of internet companies and unprofitable internet companies, this time around, the winners in AI so far are these large mega cap companies like Alphabet, like Microsoft, NVIDIA, and Broadcom, and the supply of these companies is low, and that is another plus sign for why technology can continue to do well. And I heard you earlier say that the market has hit something like 33 highs year to date, but when you look at history, Q4 from a seasonal point of view is normally a strong quarter, especially when we're up substantially year to date. So odds are in your favor for this rally to continue.
Hey, Saira, just quickly, because I know you like not just the tech hyperscalers itself, but some of the data centers and electrification play. How are you thinking about investing in that?
Well, for those who are worried about tech valuations, there are derivative plays. We've had, as our global investment committee, infrastructure has been a top pick for us for a couple of years now. We love the tailwinds there. One of them is AI data centers. So there's a company, it's a utility based in Indiana called NiSource. This utility has very strong earnings growth, high quality assets. They are a play on the build out of data centers to support AI and technology, and also the continued electrification of our economy, not only to support artificial artificial intelligence, but also to support the shift to renewable energy. So that's a way to play tech and AI, but do it in a different way from the infrastructure point of view.